make head and tail of the inflation data for us? Because it's not PCE, it's not what the Fed looks at,
Sure.
but CPI is finally breaking above the 2 percentage points.
Thanks for having me on again. So the CPI number we got today, I think it was almost a little bit of validation for Jay Powell saying that the slowdown in inflation earlier this year was transitory. And a lot of people said, oh, you're not being credible about inflation. And I think at least what we're learning now is some of that is recovering. Some of that was about seasonal adjustment problems with respect to new methodologies. And so when we actually look back, you actually look at that chart, it doesn't really look like inflation has changed all that much in the grand scheme of things.
Really?
So,
I see.
Yeah.
Soaring in July. You made a good point, and you say, okay, obviously, like maybe inflation is not dipping, but from a risk management perspective, your view is, and I think you compared it on Twitter, if they declare victory now and say, okay, we got there, and they don't see the need to cut, that's like, throwing a pick six in football, very risky. Why is that? Why should they not look at that chart and say, look, inflation's not diving, we don't have any more work to do?
Yeah, so I go back to a quote from Rich Clarida, I think back in 2007, when he says, core inflation is actually a lagging indicator by about 12 to 18 months in terms of where inflation tends to trough and peak relative to activity. So core inflation, we shouldn't really be using that as the guide for what to do next, right? It's telling us something about maybe the past 12 to 18 months. We've all had these debates about the Phillips curve, what it actually means to have a hot labor market, a hot economy. But inflation itself right now is probably not the signal to look at. It's maybe the part of the broader goals for the Fed, but let's not confuse sort of real-time indicators that matter for the future trajectory of the economy with something that's probably telling us something a little bit from further back.
So then what about the jobless rate? What if that continues to go lower? I mean, we get below 4% and we stay there. How does that change the picture?
I think it depends on what we get out of that, right? In terms of what it shows for wage growth, what it shows for sort of signs of inflation acceleration. I think it's interesting to compare what Jay Powell has been saying about the labor market now with sort of this view of the natural rate being about 4.3%. Jay Powell is actually talking about the fact that the labor market recovery we're seeing, this tight labor market, is actually helping to overcome persistent weakness in a lot of communities, low and moderate income communities, so it's starting to get to the lower end of the income spectrum, which is really different from that sort of view that we have to keep unemployment at a stable rate itself.
And it's quite a different view from other monetary policy makers at the Federal Reserve, right? This was what makes Jay Powell distinct, is he seems to be fighting for, well, taking on with monetary policy inequality in the US.
Well, at least it's part of the puzzle, right? That supportive monetary policy, trying to avoid recessions, is actually a really beneficial. It's a big benefit to communities that have typically been left out of sort of this expansion up until this point. And what he's been talking about to Congress, talking about to the public through his press conferences, that language is really actually at odds with sort of what the Fed has traditionally said, that they can only control the labor market in the short run, but long run, it's all about inflation, right?
Right. So what did Ben Bernanke, and I remember Jenny Yellen talked about this a little bit, some of the benefits of running a hot labor market, but she didn't fully go there. But talk about what did Ben Bernanke see as the limits of what monetary policy could do for some of the structural issues of the U.S. economy versus what Jay Powell apparently sees?
Yeah, so Chair Bernanke, especially in 2011 to 2013 when he was arguing for QE, the Congress was really pressuring him on the whole idea of, why are you doing this? It's not really going to matter. And he pretty much said, well, yeah, our policies can only make a difference to a certain point, but once you get to about 5 to 6% unemployment, our role kind of is to step back. We will only create inflation in the process. We're not really going to affect the long run. What Jay Powell is saying is actually, we do have a role to play still in terms of trying to at least cut off that sort of recession left tail risk, and in the process preserve the tight labor market and preserve the benefits that come from that, which are towards things that we typically said in terms of overcoming long-run weakness in a lot of communities. People who weren't hired before are now being hired. People who were written off because of their criminal records, because of factors that were, I guess, discriminatory in a way, are now being given a second chance, being given a second look.
But does this run the risk then of sort of getting a little bit too far out from what the mandate is, or trying to redefine it in a way that Congress maybe didn't intend?
Well, Humphrey Hawkins' mandate says for maximum employment, right? It's not optimal unemployment. It's not just the right level. It's maximum employment in the context of price stability. So I don't think it's actually that much of a stretch to say that this is actually consistent with that. Now, of course, like there is the fact that monetary policy is part of the picture. There are other things we could do to improve on other issues itself.
And just to button this up, we have a chart that's pretty cool that you made, you posted it, and it shows the prime age employment rate versus the FOMC longer run unemployment rate projection. What does this mean? The long run is shaped by the short run. What do we learn from this chart?
So the white line is referring to the FOMC members' projections of really the natural rate of unemployment, right? The idea of what's that just right unemployment rate below which we'll get inflation. And that's supposed to be the point where that's like not determined by central banks, it's not determined by monetary policy. But in reality, as conditions have gotten better, the Fed's own views or the FOMC members' own views of what's possible in the long run have improved, right? So as we go further in terms of labor market progress, we also learn there's more that can be done. So the short run, long run differentiation isn't as helpful, I'd say, as some might like to presume.